The Intelligent Investor by Benjamin Graham is a foundational book on value investing. It teaches how to invest wisely, avoid substantial errors, and develop a disciplined approach. The core idea is to focus on the long-term value of investments, not short-term market trends. Graham emphasizes safety of principal and adequate returns, and introduces the concepts of defensive and enterprising investors. 1. Investment versus speculation. Graham distinguishes between investing and speculating. Investment involves thorough analysis, safety of capital, and adequate returns, while speculation is trying to make quick profits without proper analysis. Example: buying shares of a profitable company with a strong track record like Coca-Cola after studying its financials is investing. Buying a random cryptocurrency based on hype is speculation. 2. The concept of Mr. Market. Graham uses Mr. Market as a metaphor for the stock market, which offers to buy or sell stocks daily based on emotion, not logic. You don't have to follow Mr. Market, instead, take advantage of his mood swings. Example: if a good company's stock drops 20% just because the market is fearful, like during the COVID crash, an intelligent investor sees it as a buying opportunity, not a reason to panic. 3. Margin of safety. This means buying stocks at a price significantly below their intrinsic value to protect against errors or unexpected events. Example: if a company's actual value is $100 per share based on earnings and assets, buying it at $70 gives a $30 margin of safety. 4. Defensive versus enterprising investors. A defensive investor prefers safety and simplicity, investing in stable companies or index funds. An enterprising investor is willing to put in time and effort to find undervalued stocks. Example: a defensive investor might invest in an S&P 500 ETF. An enterprising investor might analyze individual companies and invest in small-cap stocks with growth potential. 5. Know what you're buying. Intrinsic value. Always understand the real worth of a business before buying its stock. Intrinsic value is calculated based on earnings, dividends, assets, and growth potential. Example: if a company consistently earns $5 per share and a fair price-to-earnings ratio is 15, its intrinsic value could be $75. Buying it at $50 is a good investment. 6. The importance of discipline and patience. Markets fluctuate, but disciplined investors who stay calm and patient usually succeed in the long run. Example: during a recession, the value of your investments might fall, but if the companies are strong and you hold on, they may recover and grow. Warren Buffett didn't panic sell in the 2008 crisis. Instead, he bought more. 7. Dollar cost averaging. This means investing a fixed amount regularly regardless of the stock price, which helps reduce the impact of market volatility. Example: investing $200 every month in an index fund. Sometimes you buy at a high price, sometimes low, but over time your average cost balances out. 8. Avoiding market timing. Graham advises against trying to predict market highs and lows because it's almost impossible. Example: selling your stocks expecting a crash and waiting to reinvest often results in missing the recovery. Many who sold in March 2020 missed the rally that followed. 9. Diversification. Spreading your investments across various sectors and companies reduces risk. Example: instead of putting all your money in one tech stock like Apple, spread it across tech, healthcare, utilities, and consumer goods companies. 10. Be skeptical of market predictions and tips. Don't blindly follow news, tips, or forecasts. Do your own research. Example: a friend says to invest in a hot stock because it's rising fast. An intelligent investor investigates its real value before deciding. 11. Beware of overpaying for growth. A growing company is attractive, but paying too much for it reduces your margin of safety. Example: a stock trading at 100 times earnings because it's growing rapidly may fall hard if growth slows, like many tech stocks did in 2022. 12. Dividend policy matters. Graham encourages looking for companies with stable, reliable dividends as a sign of strength and investor friendliness. Example: a company that pays consistent dividends for 10+ years, like Johnson & Johnson, is likely stable and well-managed. 13. Understand financial statements. Basic knowledge of income statements, balance sheets, and cash flow statements helps assess a company's health. Example: if a company shows rising debt, declining profits, and shrinking cash flow, it might be risky even if its stock is rising. 14. Avoid emotional investing. Fear and greed are the biggest enemies of investors. Avoid panic selling or euphoric buying. Example: during a market rally, people may rush to buy stocks at high prices. When markets fall, fear makes them sell at a loss. An intelligent investor stays rational. 15. Stick to a sound investment policy. Have a clear plan and follow it, adjusting only when your goals or circumstances change, not due to market noise. Example: if your goal is long-term wealth, continue your regular investing schedule even during volatile markets, instead of reacting emotionally. Conclusion: the intelligent investor teaches timeless principles. Focus on value. Invest with a margin of safety. Ignore market noise and remain patient. Whether you're a defensive or enterprising investor, the goal is to protect your capital and earn reasonable returns over time through smart, informed decisions. Thank you for watching. Don't forget to like and subscribe to get more video like this.